As of the market close on Tuesday, October 21st, 2025, shares of Texas Instruments, ticker TXN, finished the official session at $180.84, up $1.25 or 0.70% on the day. But that price, $180.84, is an illusion right now. It's a snapshot of a market that, just hours ago, held a completely different set of beliefs about this company. As we speak, the U.S. markets are closed for the session of October 22, 2025, and investors are left to digest the after-hours implosion. Immediately following their third-quarter earnings release, the stock didn't just dip, it fell off a cliff, tumbling roughly 7% to 8% in post-market trading, wiping out all of yesterday's gains and then some. This is the critical tension, the massive gap between the market's expectation heading into the print and the cold, hard reality delivered by management. Let's establish the common ground, the narrative everyone was holding on to. Texas Instruments isn't a flashy momentum name. It's not the kind of stock retail traders on the Robinhood app or SoFi Invest pile into hoping for a 1,000% return. It's not Tesla stock with its massive volatility, or Nvidia stock riding the white-hot generative AI wave. No, TXN is supposed to be the adult in the room. It's a bellwether for the real economy. They make analog chips and embedded processors, the essential, less glamorous components that go into industrial machinery, new cars, medical devices, and factory automation. Because their client list is so broad, spanning tens of thousands of customers, Wall Street watches TXN as a canary in the coal mine for global industrial and automotive demand. The expectation, the hope, was that after a brutal inventory correction that hammered the semiconductor industry for the last year, TXN's report would be the all-clear signal. The belief was that the worst was over and the cyclical recovery was here. And then reality hit. The Q3 numbers themselves weren't the catastrophe. In fact, they looked pretty good on the surface. Revenue came in at $4.74 billion, which was comfortably ahead of the $4.65 billion consensus estimate. Earnings per share at $1.48 were essentially in line with, or just a penny shy of, varying analyst expectations. The company's core analog segment revenue was up a very healthy 16% year-over-year. Embedded processing was up 9%. On paper, this looks fine, maybe even strong. If you were just glancing at the headlines, you'd wonder why the stock was collapsing. The entire story, the whole reason for the post-market panic, was buried in one place: the guidance. For the upcoming fourth quarter, Texas Instruments management projected revenue in a range of $4.22 billion to $4.58 billion. The midpoint of that, $4.4 billion, was a massive disappointment to a market that was braced for $4.51 billion. Worse, they guided Q4 earnings per share to a range of $1.13 to $1.39. The street was looking for $1.40. This wasn't a small miss. It was a clear signal that the recovery everyone had priced in is not happening as planned. The CEO, Haviv Ilan, said it plainly. The overall semiconductor market recovery is continuing, though at a slower pace than prior upturns. That one phrase, slower pace, is what's costing shareholders billions in market cap this morning. The market expected a sharp V-shaped rebound, and TXN just told them to prepare for a long, slow, uncertain grind. This is where the expectation versus reality framework becomes so critical for any online investment strategy. The stock isn't just a number, it's a story, and the story just changed. Yesterday's trading, with volume at 9.9 million shares, well above its 6.7 million average, shows that the market was anxious. Big players at firms using sophisticated interactive brokers platforms and wealth managers at Fidelity Fidelity were placing their bets. The positive 0.70% close suggests the smart money expected good news, or at least not bad news. The after-hours reaction shows a complete repricing of that expectation. This is where self-investing gets tricky. You might have seen the Q3 revenue beat and thought it was a buy, only to be blinded by the forward-looking statements. Let's dig into those end markets, because that's where the real story is. The company reported that its industrial market sales grew 25% year-over-year. That sounds fantastic. But its automotive market, long touted as the key long-term secular growth driver, grew only in the upper single digits. In a world obsessed with the EV transition and the chip content in new cars, upper single digits is a worrying figure. It suggests that even the mighty automotive sector isn't immune to broader macroeconomic dynamics, as the CEO put it. This is the friction. We hear about the boom in electric vehicles, yet the primary supplier of chips to that market is signaling a slowdown. This is a data point that investors in Tesla stock should be paying very close attention to. This weak guidance now puts TXN's entire capital allocation strategy under a microscope. This is a company famous for its dividend. They just announced a 4% dividend increase to $1.42 per share, marking 22 consecutive years of dividend growth. This is the kind of stock people build their retirement around in Fidelity IRAs or have as a core holding in automated Schwab Intelligent portfolios. But this dividend growth is funded by free cash flow, and free cash flow is being squeezed. The company is in the middle of a massive capital expenditure cycle, spending $4.8 billion in the last 12 months to build new 300mm wafer fabs in the U.S. This is a long-term strategic positive, giving them cost advantages and supply chain control. But in the short term, it means they are spending billions right as their revenue growth is decelerating. Trailing 12-month free cash flow was just $2.4 billion. That's a tight squeeze. This isn't a fire alarm, but it's the kind of pressure that makes institutional holders who own over 91% of this company very nervous. So what happens now? The stock is said to open deep in the red, likely somewhere around the 166 to 168 level. The consensus rating on Wall Street before this report was a lukewarm hold, with an average price target around $209. You can expect a flurry of downgrades and price target cuts this morning. Analysts at BA and Mizuho had already downgraded the stock before the report, citing caution. They're going to look like the smartest people in the room today. For the average person managing their individual brokerage account through a Fidelity trading platform or the Robinhood app, the question is what to do. The high-flying momentum of the market, which has lifted Apple stock and others, has clearly masked underlying weakness in the industrial economy, and TXN just pulled back the curtain. This is the kind of environment where investment help is crucial, but ultimately, the decision rests on your time horizon. The bull case, the expectation, is that this is a temporary air pocket. The long-term trends of electrification and automation are intact. TXN is investing heavily, and when demand does return, its new, efficient fabs will make it a profit machine. You buy this dip, reinvest the dividend, and in 5 years, you'll be happy. This is the Fidelity Mutual Funds approach. The bear case, the reality, is that the CEO is right, and the slower pace is a nice way of saying recession. The high growth days in industrial and auto are over for a while. The company will be bogged down with high capex, stagnant revenue, and margin pressure. The stock will become dead money, trading sideways for the next 2 years, while other sectors, or even other semiconductor stocks like Nvidia stock, continue to outperform. Traders on Interactive Brokers will likely be looking at this as a short-term shorting opportunity. So, here's the question for everyone watching. Based on this weak guidance, are you a buyer of Texas Instruments for the long-term dividend and eventual recovery? Or are you selling, fearing this is the bellwether signaling a much broader industrial slowdown? Comment below. Ultimately, the market just experienced a classic narrative break. The expectation was that Texas Instruments, the steady, reliable heart of the industrial economy, would confirm the recovery. The reality is that the company just flashed a bright yellow warning light. The closing price of $180.84 is history. The real battle for TXN, and for the market's confidence in the economic cycle, begins when the opening bell rings. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Thumbs up.